Welcome to The Deep Dive, the platform where we take a complex stack of earnings reports and investor presentations and, well, we try to extract the absolute nuggets of insight you need to understand what's really driving the market.
And today we're undertaking, I think, a really critical deep dive into the Q2 FY26 results for Hindustan Unilever Limited, or HUL. This covers the quarter ending September 30, 2025.
Yeah, a hugely important call. It happened just after Indian market hours on October 23rd.
Exactly. And it wasn't just any earnings call, was it?
No, not at all. It felt like a real moment of transition. We have to note, this was the final earnings appearance for the current CFO, Ritesh Tiwari. He's off to a new global role.
Right.
And maybe more importantly, it was the first major strategic presentation we heard from the new CEO, Priya.
That definitely set a certain tone, didn't it? That mix of, outgoing pragmatism and incoming ambition.
It really did.
And look, before we dive into what were some fairly tough numbers, we should probably mirror the sentiment from the call itself, wishing you and your loved ones a happy and prosperous Diwali season.
Absolutely. Happy Diwali, everyone. Okay, let's get into it. The financials that caused some immediate turbulence.
Right. The market's verdict was, well, pretty swift and negative.
Yeah, the stock closed down, 3.27% the following day? That signals investors were really zeroed in on the near-term volume and margin pain, not really looking at silver linings or long-term stuff.
And you can see why when you look at the core operating numbers. Total revenue, 16,241 crores. That's a modest 2.0% growth year over year.
Modest being the key word there.
Definitely. But the metric that truly defines a consumer goods giant like HUL, especially in India, is volume. Their underlying volume growth, UVG, was flat. 0% year over year.
Flat volumes in this market. That's what fundamentally spooked investors, I think.
Absolutely. It's that critical difference, isn't it, between growth from price hikes and growth from actual consumer demand picking up.
Right. Now let's look at profitability, because there was a kind of deceptive headline number there too. Consolidated profit after tax, the PAT, it grew a decent 3.6% to 3.8%, landing around 2,690 crores.
But, like you said, deceptive. That growth was largely artificial. This is where you really need to dig in.
So what was driving it then?
Well, the entire reported PP growth basically came from a significant one-time positive impact. About 184 crores from resolving some prior year tax matters.
Ah, okay. So a tax windfall.
Exactly. If you strip that out, the operational profit growth was, well, essentially zero, which kind of confirms the market was right to look past the headline PT and focus on the operating reality, which was flat UVG.
And that operating reality also included margin pressure.
Yes. The EBITDA margin contracted by 90 basis points year over year. It settled around 23.0%.
Still a healthy margin in absolute terms.
Yeah.
But the direction of travel is key.
For sure. On the balance sheet side, though, things look stable. The board declared an interim dividend of €19 per share.
Okay, so the immediate picture is pretty clear. Flat volumes, margins under pressure, and a profit headline propped up by a one-off tax gain that didn't fool the street.
Exactly. So we really need to spend some serious time digging into management's explanation for why volumes stalled like that. They blamed specific external shocks.
Right. They framed it as a transitory channel and sales disruption. And they said this was down to two main forces hitting them at the same time. First was the government's GST rate changes, the reforms.
Yeah, that impacted a huge chunk, 40% of HUL's portfolio. It moved nearly half of those products into that lower 5% tax bracket.
Which long-term should be good for consumers, but short-term, chaos.
Pretty much. Management actually put a number on it. They estimated this GST transition cost them up to 2% in volume across the whole business just in this quarter.
2% just from GST?
No,
Wow.
it's twofold. Trade partners destocking the old inventory with the higher tax, and then consumers kind of holding off buying while they waited for the new lower prices to actually hit the shelf.
Okay, that makes sense. And the second shock?
Environmental. Just prolonged and intense monsoon conditions across several key regions. That obviously disrupts physical supply chains, trucks getting stuck, that sort of thing. And it also tends to dampen consumer demand a bit, especially out in rural areas.
Okay, so GST plus monsoons.
Yeah.
Let's just, push back on that framing for a second. They're blaming 2% on GST, implying the monsoon hit the rest. For a company as sophisticated as HUL.
You're asking how much is a genuine external shock and how much is maybe management using that to explain away some underlying softness?
Yeah, exactly. I mean, even with those shocks, zero volume growth feels like a significant underperformance for a company that really relies on penetration growth.
It's a fair point. That context is definitely important.
Yeah.
Okay, let's move from the sort of macro shocks to their internal operations. Despite that flat UVG, imputed pricing growth was actually up about 2.1%.
So they did take some price.
Well, yes and no. What's really interesting here is management confirmed they passed the entire GST rate reduction benefit straight through to consumers.
Yeah.
They did this with price cuts and grammage changes across something like 1,200 different SKUs.
Wow, 1,200. That's massive operational agility.
It is, and it shows discipline, right? They took the short-term volume hit to make sure they were the most competitive on price once things settled down.
Okay, which brings us back to margins. We said EBITDA margin contracted 90 basis points year over year. Why was that if they were passing through GST cuts but commodity costs might be easing?
Good question. It was largely due to stepped-up investment. Specifically, advertising and sales promotion A&SP was significantly up compared to last year. They are spending heavily behind the brands right now.
Investing for future growth. Makes sense.
Exactly.
Yeah.
But there is some underlying good news on the margin front. Gross margin actually improved sequentially quarter on quarter by 130 basis points.
Okay, that is a key sign. What does that tell us?
It suggests that price versus cost gap is starting to moderate. Commodity costs are probably stabilizing or falling in some areas, helping the underlying profitability. It reinforces that their playbook seems disciplined, protect profit where possible, but strategically invest heavily behind brands for the long haul.
Got it. And how did this play out across the different segments? Was there any resilience anywhere?
Yes, definitely. The beauty and well-being division actually held up the best. It delivered 5% underlying sales growth.
Okay, 5% is pretty decent in this environment. What drove that?
Mostly strong performance in skincare. They called out Vaseline and Lakme specifically, and also health and well-being. Remember their acquisition, Aziva. That apparently delivered triple-digit growth.
Wow, triple digit. Okay, so clear indication that premiumization is working in certain pockets.
Absolutely. Then you look at home care, which is their biggest segment. That reported flat underlying sales growth.
Flat again, but is there context there too?
Yes, very important context. Home care looked flat largely because they aggressively cut prices. This was in response to commodity deflation, things like crude oil being down over 10% year over year.
So they passed those savings straight through to the consumer.
Exactly, which is the right move operationally to defend market share. And actually, on a strong base from last year, home care still delivered competitive mid-single-digit volume growth, so the category itself is still quite healthy.
Okay, that makes sense. It shows the underlying demand is there.
Right, and it reinforces their broader strategy focus, like keep investing in premium stuff. They mentioned things like Comfort Perfume Deluxe, the expanded Luxe International soap range, and even Horlicks Pro Fitness. That's a meal replacement targeting health-conscious city dwellers.
Interesting. But look, the biggest forward-looking piece probably wasn't in the Q2 numbers themselves, but in the CEO's prepared remarks. Priya Nay setting out her stall.
Yeah, this felt like her moment to really define the path forward. She outlined 4 core strategic pillars. This is about driving medium to long-term, volume-led, profitable growth. This is the strategy they'll be judged on now.
Let's spend a bit of time on these. What was the first one?
The first pillar she called radical segmentation. This sounds like moving beyond just traditional product categories.
Radical segmentation. What does that actually mean for HUL?
It seems to mean sharpening their consumer targeting into 3 really distinct groups. First, the power spenders. They estimate 60 to 80 million consumers right at the top of the pyramid.
60 to 80 million. That's a huge group of affluent consumers.
It is. Then premiumizers in the middle and democratizers at the bottom, presumably focused on value.
That word radical feels key, though. It suggests a shift from just chasing mass market volume everywhere.
I think so. It sounds like tailoring everything, product, packaging, channel, media spend specifically to capture those 60, 80 million high-spending urban consumers more effectively. Maybe fighting off premium competition better.
Okay. Pillar 2.
Elevating brand desirability. Basically, making the core heritage brands feel modern and cool again, while also scaling up the premium portfolio with constant upgrades and new launches.
So stopping brands like, say, Luxe or Lifebuoy from feeling dated and bridging the gap to newer, D2C brands.
Exactly. Connecting with younger audiences who might be drawn to niche players.
Makes sense. Third pillar.
Future-proofing capabilities. This is all about adapting to how people shop now. Accelerating digital channels is key here.
Like online sales.
Yeah, and specifically quick commerce, getting stuff delivered in minutes. They said that channel doubled year over year for them. To win there, they need a social-first demand generation, think less TV ads, more Instagram and YouTube driving discovery.
Right, meeting consumers where they are. And the final pillar.
Number 4 is reshaping the portfolio. This means investing disproportionately in high-growth areas where penetration is still low, basically trying to scale up new markets.
Any examples?
The key one they gave was body cleansing liquids like shower gels. Apparently, that category only has about 2% penetration in India right now.
Wow, only 2%. That's a massive potential market to build.
Huge, but it requires market development, convincing people to switch from soap bars, not just capturing existing demand.
Okay, so that's the long-term vision.
Yeah.
What about the immediate outlook? Did they give any guidance?
They sounded, reasonably confident about normalization setting in from early November. Once those GST price changes fully filter through the trade channels and things stabilize.
So they expect a gradual sequential recovery in volumes starting Q3.
That seems to be the expectation. But maybe the other really crucial part of the forward-looking story came out during the Q&A. It was about the ice cream demerger.
Ah, yes, the demerger. That's a structural game changer for margins, isn't it?
Absolutely. This is where we see a kind of guaranteed uplift. The plan is for the demerger to complete by December 2025, so probably listing in Q4 of this fiscal year, FY26.
And the impact.
Well, the ice cream business runs at a structurally lower margin than the main FMCG business. So taking it out will automatically improve HUL's reported EBITDA margin by about 50 to 60 basis points immediately upon separation.
50 to 60 basis points. Just like that.
Just like that. It's a structural uplift, completely separate from commodity prices or anything else, and it should be effective from the Q3 results reporting onwards.
So their core medium-term guidance is still that 22% to 23% margin range.
Right, but now you can essentially add this 50 to 60 basis point demerger benefit right on top of that. It's a very clear path to structurally higher reported earnings per share.
That creates a really interesting setup for the second half, doesn't it? You've got the easing of the short-term GST volume pain, plus a guaranteed structural margin boost coming through.
Exactly. And it feels like the market, in its panic over the flat Q2 UVG, completely missed that guaranteed uplift on the day.
Which brings us very neatly to our segment. This is not financial advice. Just to be absolutely clear, we're discussing potential trade ideas based only on the data and the structural analysis from the earnings call. This is purely for discussion.
You absolutely must do your own research and due diligence before making any investment decisions. Okay, disclaimer done.
Right. So the stock dropped over 3% because the market saw zero volume growth, contracting margins, basically one bad quarter. The core idea here is that the market seems to be valuing temporary cyclical pain.
While maybe ignoring guaranteed structural gain.
Exactly. So the temporary pain is that estimated 2% GST volume shock. Management themselves said it's transitory, should end early November.
Right, which sets up an easier comparison, an easier volume base, and likely sequential recovery in Q3 and Q4. The volume story looks like it's bottoming out and recovering.
Then the structural gain.
That's the guaranteed margin uplift, 50 to 60 basis points hitting the P&L soon, locked in by the ice cream demerger. It's basically an earnings upgrade baked in starting next quarter.
So you've got a business potentially seeing a volume rebound and a structural margin boost happening almost simultaneously.
Correct. Therefore, our outrageous but plausible trade idea is long HUL stock. The bet is that the market will quickly recognize the temporary nature of the Q2 shocks.
And start valuing that guaranteed 50-60 BPs margin accretion.
Precisely. Forcing analysts to upgrade earnings models, potentially allowing the stock's multiple to hold up or even expand back towards its historical premium. The thinking is the short-term pain has been paid for, but the structural gain hasn't been priced in yet.
Okay, so wrapping up this deep dive then, HUL's Q2 results really showed this core tension, didn't they? Flat volumes, drifting margins because of that GST shock and the monsoons.
Yeah, but contrasted against some strong structural positives, like the resilience in premium segments and that very clear guaranteed path to higher reported margins coming from the ice cream demerger.
So our final thought for you to chew on, thinking about the new CEO's strategy. HUL is making a really big bet on premiumization and this radical segmentation.
The question is, will targeting those 60 to 80 million power spenders and trying to rapidly scale up underpenetrated categories like body wash liquids be enough? Will it actually reignite strong volume growth in categories that have historically been seen as pretty mature staples in India? That's the big strategic question going forward.
Indeed it is. Well, thank you for joining us for this deep dive into HUL's Q2. Remember, all the information presented here is for informational purposes only. We'll catch you on the next call.